Listen to me. If you are retired or anywhere close to retirement, I need you to lean in and pay close attention, because there is an invisible tax trap sitting right in your financial path, and it is ready to bite you the moment you turn 73. For 30 or 40 years, you did what you were told. You saved dutifully in your traditional 401k and traditional IRA accounts. You watched those balances grow tax-deferred, and you thought, when I retire, my income will drop, I will be in a low tax bracket, and everything will be smooth sailing. Are you kidding me? The moment you hit the age where the government forces you to take required minimum distributions, your RMDs, that peaceful tax expectation gets blown completely out of the water. It triggers what financial planners call the tax torpedo, and if you do not see it coming, it will sink your retirement cash flow faster than almost anything else. Here is the problem. RMDs are not optional. The IRS requires you to start pulling money out of those pre-tax accounts whether you need the cash to live on or not. Every single dollar you withdraw gets added directly to your taxable income as ordinary income. And here is where the fear turns into reality, that extra forced income collides directly with your Social Security check. Many retirees believe Social Security is completely tax-free. It is not. The government uses a calculation called provisional income. When your RMDs force your provisional income above certain thresholds, just $25,000 for single filers or $32,000 for married couples, up to 50% of your Social Security becomes taxable. If your income goes above $34,000 single or $44,000 married, up to 85% of your Social Security benefits become subject to federal income tax. Do you see what is happening here? One single extra dollar from an RMD doesn't just get taxed by itself, it drags an extra 85 cents of your Social Security into the tax net right alongside it. You think you are sitting comfortably in a modest 12% or 22% tax bracket, but because of this compounding effect, the effective marginal tax rate on that withdrawal can jump to 30%, 40%, or even higher. That is the tax torpedo. And it gets worse. Higher reported income can also trigger IRMAA surcharges, driving up your Medicare Part B and Part D premiums. You end up paying more for your healthcare and more to Uncle Sam, all from money you were forced to withdraw. So ask yourself, are you going to sit back and let forced distributions dictate your financial freedom, or are you going to stand in your power and take control right now? You do not have to be a victim of the tax code. Here is your actionable plan to defuse the tax torpedo before it ever launches. First, take advantage of your gap years. These are the years between the day you retire and the day your RMDs and Social Security begin. This is your golden window. Work with a trusted professional to perform systematic Roth conversions. Move money out of your traditional pre-tax accounts into a Roth IRA while your income is low. Yes, you pay tax on the converted amount today, but you pay it at lower, controlled bracket rates. Once that money is in a Roth IRA, it grows tax-free, withdrawals in retirement are completely tax-free, and most importantly, Roth IRAs have zero RMDs during your lifetime. Smaller traditional IRA balances mean smaller forced RMDs later, keeping your provisional income under control. Second, if you are age 70 and a half or older and you donate to charity, use qualified charitable distributions, QCDs. A QCD allows you to send money directly from your IRA to a qualified charity. That money counts toward your RMD requirement, but it never touches your adjusted gross income. It stays off your tax return completely, protecting your Social Security from being taxed. Third, plan your withdrawal sequence intentionally. Do not pull blindly from one account. Balance withdrawals across taxable brokerage accounts, traditional pre-tax accounts, and tax-free Roth accounts so you stay right under the tax bracket thresholds that trigger higher taxation on your Social Security. You work too hard for your nest egg to let surprise tax spikes take away your peace of mind. Stand in your truth, plan proactively, and keep your hard-earned wealth where it belongs, in your hands.